So you want to buy a home but just don't have the money for the down payment on a home? Don't worry, there are options for you and I'm going to show you what those are in this video. Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages. And it's very common for someone to be ready to buy a home, have the income to make the payments on that home, but just not have enough money or any money to make a down payment on a home. So in this video, I'm going to show you the 3 most common down payment assistance or 100% financing types that are available to help you make that purchase if you're short on funds. The first type of loan we're going to look at is Freddie Mac's 100% conventional financing. Now, with this particular option, it's going to be limited to individuals whose income is 80% of the area median income where they're looking to purchase or below. And you can look that up using the tool in the description of this video below. So let's assume you meet that requirement. We're going to look at this. So Freddie Mac, we're going to use FHLMC 100%. So in this case, let's just say that our purchase price is $300,000. As a first-time homebuyer, which you have to be for this program, your down payment is going to be 3% of this purchase price. So we're going to say your down payment is 3%, which is $9,000. But we just said you don't have your own money to use toward the purchase. So where's $9,000 coming from? So with this particular type of 100% financing option, which is a conventional mortgage, so it's very uncommon, this $9,000 is actually going to be given to you in the form of a second mortgage from the lender you're utilizing for the purchase. So we're going to say $9,000. This will be a second mortgage. And by second mortgage, what I mean is that the amount you're borrowing, the 97%, right, because you're putting 3%, that's your first mortgage. Second mortgage is just another mortgage on your property. So second mortgage will be for $9,000, right? So that covers your 3%. So let's just say that we're at $300,000, as I mentioned. We know that we have a down payment of $9,000, which means your loan amount is going to be $291,000. But now we have a second mortgage of $9,000. We add these two together, and that gives us the $300,000, which covers the purchase price. Now, here's what's pretty cool. You might say, I don't want a second mortgage on my property. You know what? Well, here's how you have to look at this. For one, this second mortgage, it's pretty cool. It's at 0% interest, meaning you're not paying any interest on it, and 0 payment. So on this money that you're getting to help cover your down payment, you're not paying any interest on it, you're not making monthly payment on it. Now, you do have to pay it back when you either refinance the first mortgage, right, meaning pay it off with a new mortgage, probably at a lower interest rate, or you sell the property. It has to be paid off. But either way, if you were taking one loan for $300,000, you're in the same scenario. It has to be paid off when you refinance, or you have to pay it off when you sell. So you're not in a different boat when it comes to that. The nice thing, though, is that you're not paying interest on 3% of that sale price, right? If you were able to get one loan for 100%, and let's just say the rate was 7%, you'd be paying 7% on $300,000. In this case, let's say the rate's still 7%, you're paying 7% on $291,000. So your monthly payment would actually be lower when you look at it from this perspective, right? Because you have 0 interest, 0 payments on that second mortgage. So this is your first option. Now, there are very few lenders that offer this. I know that we do. However, make sure if you're looking for an option that's a conventional mortgage, right? You really want conventional. You don't want to look at FHA or maybe another alternative. Maybe you're not a veteran who can qualify for a VA loan with no money down. Well, this is a great option for you to consider. Just make sure you find a lender who's able to offer this to you. Now, and just to say, most brokers, if they have access to United Wholesale Mortgage, should have access to this particular program. Now, the next option, we're going to talk about 100% FHA financing, right? So let's use some of the similar numbers. So we're going to, once again, say our purchase price is $300,000. Our down payment, because it's FHA, the minimum down payment, if you've watched any of my videos on FHA specifically, is $10,500, because that's 3.5% of the purchase price, which leaves a loan amount of $289,500. Now, just like the Freddie Mac option that we just talked about, you don't have money for this down payment, right? We've already determined that. That's why you're looking at these options. So where does that money come from? Well, this is going to come in the form of you guessed it, a second mortgage. So once again, you're going to have a second mortgage for $10,500 on the property. Now, here's something that's going to be a little bit different than with the Freddie Mac option. There's 2 versions of this particular loan, right? So you have repayable, which means that this money gets paid back, and you have non-repayable. It doesn't get paid back, right? So if you go with the repayable option, which I actually would say is the most common, well, repayable option is going to have a lower interest rate for the first mortgage, because this is actually going to, this second mortgage, having this on here and using this program, causes the mortgage on the first lien, right, which is your main mortgage, the 289,500, to be higher. If you go with the non-repayable, it's going to be even higher than that, right? So let me give you some examples. Let's just say that the interest rate for the first mortgage using this program is, I want to write dollars for some reason. Let's say the interest rate for this program is going to be 7.5%, right? Well, the way that you determine the interest rate, because it's not like this Freddie Mac where it's 0% interest, zero payment, if you're doing the repayable, right? If we're doing the repayable option, you're going to have a payment, you're going to have an interest rate. This is how it is. You're paying the money back. So this 10,500, the way to figure out the interest rate and the payment is you take your rate on the first mortgage, 7.5 in this example, you add 2% to that, and that's going to give us a 9.5% interest rate, right? In this example, like, whoa, my 9.5%, that's crazy. And I agree, it's high, but this 9.5% also, rather than this loan being a 30-year, this has to get paid back over 120 months, which is 10 years. So the payment that comes along with this is a little bit higher. However, something you need to consider, it's at a relatively small loan amount. So don't let the rate and the term scare you, right? So we have 10,500, 10-year term at 9.5 interest, right? So just to show you, just so you're not like, oh my gosh, I don't know why I would ever do that. The payment on this, in this example, would be $135.87 on the $10,500, right? It's not some crazy number. It's money, don't get me wrong, but it's not thousands of dollars. I just want to be clear on that. And of course, you'd have your regular amortized 30-year payment on your first mortgage based on the 7.5% interest rate. But the nice thing is that you didn't have to put any money down, right? Because you're doing 96.5% plus 3.5% equals 100%, and therefore you have no down payment, and your payment's $135.87 on the money that you essentially borrowed to cover your down payment. If you do the non-repayable option, you would not have a monthly payment, but the interest rate on the first mortgage in most cases is nearly a full percent higher than what it would be if you did the repayable. So that's going to make a much larger jump in your monthly payment than just 130, call it 136 bucks in this example, right? So I typically lean toward the repayable option since it's going to give you an overall lower monthly payment, therefore lower interest rate on the first mortgage. And just like with the Freddie Mac option, if you ever refinance or sell the property, you do have to pay this off. It's likely you would refinance once you see rates go down and you've built up some equity in your property. Those are two options. Now, another option, right, is going to be we're here in Florida, I'm going to give you that option. So let's just say that it's the Florida bond program. And the Florida bond program gives you $10,000 towards your purchase, and it's available on a conventional loan, and it's also available on an FHA. Let's just say for this example, we're going to go with the conventional option. So conventional option, once again, purchase price, $300,000. Down payment, you're a first-time buyer, which you need to be for the Florida bond program, 3%, which is going to equal $9,000. Once again, where's this money coming from? Well, it's coming from the bond. But here's what's cool about the bond program. It is a second mortgage, right? We have $10,000. It is a second mortgage, but once again, zero interest. I love those dollar signs. And zero payment. But what do you notice here? Your down payment's $9,000, but you're getting a $10,000 bond. In this scenario, you're actually getting more than 100% of the purchase price. So you have $9,000 to cover the down payment, plus you have a surplus of $1,000 for closing costs. What's also cool about the Florida bond program specifically is that the state and city stamps that anyone buying in the state of Florida is required to pay on their mortgage when they're getting a mortgage, you're exempt from those. So you would normally pay 0.55% of your loan amount for stamps on the mortgage if you're getting any type of mortgage. However, because you're using a Florida bond program, that's eliminated, reducing your closing costs even further, meaning that you're going to have even less money that you need out of pocket when utilizing this program. Now, something to consider is that when you're using the Florida bond program, It doesn't matter what lender you're using for this, the interest rate is going to be identical from lender to lender. So you might say, oh, I'm going to shop around. Well, if you're using the bond program, you can shop around maybe based on personality, right? You enjoy working with someone or you felt they educated you more so than someone else. I can understand that. But if you're shopping around for cost or for interest rate, it will make no difference if you're utilizing this specific program, because the interest rates for this program are set by the state of Florida, not by the lender themselves. So you can go to me, you can go to the bank if they offer it, you can go to a broker if they offer it. We're all going to offer the same exact interest rate for this program for the same borrower. It's just not going to vary. Could it vary from day to day? Yes, but if you're doing it all on the same day, the cost and the rate will be identical. So keep that in mind. So assuming you're not a military veteran or active duty military, these are great options for purchasing a home with zero money down. If you want to learn more about other types of loan products and just mortgages in general, make sure to subscribe to my channel for more videos just like this one. And if you have questions about your own scenario, I'm happy to answer that. Just leave a comment below because I do respond to 100% of the comments left on my videos.